Did you realize that Walgreens has the highest dividend payout for an S&P 500 company at 12.7%? And now that you know that, then have you thought about how an ETF like YieldMax's YMAX can have a dividend payout of 35%? I mean, seriously, does it really have quality companies that are paying that high of a dividend? And is a 35% dividend sustainable? These are all the questions that I'll be answering in this video, along with my personal opinion about the pros and the cons of YMAX and who it's most suitable for. Now, I'm going to give a little context about why I'm doing this video. I was at an event a few months ago where some very big name YouTubers were attending and YieldMax happened to come up. Unanimously, everyone stated that they would never discuss these ETFs and they would avoid them on their channels at all costs because their opinion was they don't agree with them. But for me, regardless if my opinion is negative or positive, I think it's best to share out the facts with all of you and let you come to your own decision. Because in my opinion, apathy or just saying nothing, well, that can be just as dangerous as sharing the hard truth. And I have had a lot of questions from viewers about YieldMax, so I thought it was about time that I covered it. So let's get started with who YieldMax is. They happen to be two financial groups of Tidal Investments and 𝐓𝐨𝐸 Financial that created a group of funds where their first ETF or exchange traded fund was in 2022 with the TSLY Option Income Strategy Fund based on the Tesla stock. Since then, they've launched over 30 different income generating funds. Now, the way that they generate income on a weekly or even a monthly basis, depending on the fund, is by writing call and put options on or against the security. And before I get too deep into this, I highly recommend that you watch my video on Options 101, where I go over the basics of options trading. This will make it much easier to understand this video. Regardless of your knowledge set, options happen to be very complicated, so I'm not going to spend a ton of time on the mechanics of options. Now, as for the majority of the funds that are offered by YieldMax, they happen to be based on individual securities. For example, the TSLY fund is based on the Tesla stock, APLY is based on Apple, and NVDY is based on Nvidia, where options contracts are written specifically upon those securities. And because those funds focus on one security for the options trading, it carries a lot more risk that's tied to only one asset's performance. But on the flip side, the YMAX fund that I'm speaking to mostly in this video is a fund that is a combination of all other YieldMax funds to minimize the risk, but it may also minimize the potential upside. So if we look at the holdings for YMAX, you'd see that it is nothing other than the rest of all other YieldMax funds within it. And these sets of funds utilize two main types of options called the covered call strategy and the credit spread strategy. To give you a generic understanding of these, let's start with a covered call strategy. Imagine that you have yourself an apple orchard. On one hand, you can sell the apples that you grow each year, or on the other hand, you can sell the right for someone else to pick and sell those apples for a specific tree. Selling the right to the fruit from a specific tree, well, it's just like selling a covered call option. Because you, the orchard owner, are like the investor who owns the underlying stock. The person buying the right to your tree's fruit is like the option buyer. The money the buyer pays you for the right to the tree's fruit is like the premium that you get from selling the call option. But if the apple market booms and apple prices skyrocket, you don't get the benefit of the extra profit from the trees whose rights you've sold off, because that profit goes to the buyer. In very rough terms, this is a covered call. Okay, now I am not going to explain a credit spread because it's much too complicated for my editor to even attempt to map out. Just know that they are both selling and buying call options at different strike prices on the same asset, aiming to generate income from minimizing risk from two different potential outcomes. My overall point is that funds generating income from options trading, well, it's complicated. But you know what's not complicated? Generating income on a monthly basis from owning your own business. Then there is an option that pays 7 to 9% a month on invested capital. That's where today's sponsor, Limits Express, comes into play. They work as business managers to create and manage an Amazon store just for you, where they buy and sell national branded products using your capital and business. They do all the heavy lifting and all of the day-to-day work. They don't get paid unless your Amazon business makes a profit. In full transparency, I have invested with Limits Express to vet them out and to verify their process. Starts off a little bit slow because you need to get approvals to sell the brands, but that's due to Amazon and its processes. So if you're interested in learning more, I'll have a link down in the description so that you can speak directly with Kyle, which happens to be one of the co-founders. You can also check out their website down in the links below. And please keep in mind that all investments carry some level of risk, and this is not a personal recommendation. Since YMAX is made up of all other funds, let's look at the holdings of one of these specific funds. So in looking at APLY fund from YieldMax, it's made up mostly of US Treasuries as the backing asset for them to write their option trades. So the fund does get a little bit of upside from the Treasuries, and it gives it some stability, but the bulk of the income is from actively trading options contracts. And of course, once you hear the term actively managed, your instinct should immediately have you question the expense ratio. And the expense ratio on most all of the YieldMax funds are at 0.99%. But for the YMAX fund, it is 1.28%. And the beta is a 1.18, which is a little bit more volatile than the market index. Now, one of the reasons that YMAX has a higher expense ratio than all other funds held within it is because it is constantly rebalancing out the internal funds to keep them equally weighted. This activity also increases costs on the fund, and it reduces its overall performance. And for some of you savvy investors, if you're wondering, yes, you could just invest an equal amount into all 30 funds and essentially create the YMAX fund yourself, but you won't be getting the benefit of having it constantly rebalanced. And at the end of the day, you'd only be saving yourself 0.28% or about $2.80 per 1,000 invested each year. But I get it. Every dollar counts. Since the YMAX fund has only been around since January of 2024, there's really not a lot of history. But when we compare SPY, which is an index to the S&P 500, to the YMAX, they are less than 4% different in a total return. And keep in mind that the total return has all the dividends reinvested back into the fund, and it's not accounting for the tax implications either. Overall, I'm guessing that some of you might be just a little bit surprised by this. But wait a minute, if the dividend return is 35% and it's reinvested, then why isn't the total return higher than that? So let's look at the fund price return. And now, well, the story seems completely different. Now YMAX is at a negative 7%, and the SPY is still over 31%. This should flash up some serious warning signals to most everyone watching, right? Especially for this guy right here in the comments, because he seems to really like YMAX. So just looking at the price of the stock, removing the dividends from the conversation, if you bought $1,000 worth of YMAX at the first of the year, that fund is now worth $921. And the SPY fund would be worth $1,381. Any fund, regardless of how much dividend it's receiving, if its price declines over time, it isn't very healthy. Well, at least that's my opinion. Granted, all of you savvy investors can simply state that you can reinvest that negative 7% loss in price back into the fund from the dividends that were received, while still taking a healthy dividend of 28%. And that is 100% true. You can make it work. But there's another chart that I want to show you. Back in August of 2024, we had a major drop or a pullback in the stock market. In this chart, it's showing how YMAX reacted compared to the S&P 500, which was up over 7% at that time. It happened to take the dip and it came out just fine. But YMAX, both the price of the fund and the total return, dropped substantially more than the market, where the black line is the total return at negative 2.2% over that time. But the price of the fund will happen to go down negative 11.7%. Look, my point in showing this is that options trading has substantial risk when there's a major shift in the market, either a big drop down or even a major spike up, and the options will typically be the biggest loser in the group. However, if we're in a consistent bull market, then YMAX does prove useful in generating a lot of weekly income. And if the markets have been bearish for quite a while, then options traded funds like YMAX may be able to perform better than the market so long as the pricing of the fund doesn't drop too much. Because regardless of being in a bear or a bull market, the ability to generate income from options isn't going to change. If I were ever going to invest into YMAX, I would ensure that I had it in a tax-advantaged account like an IRA. If not, then the dividend taxes will hit you hard in the year that they are earned. I would also need to be in the mindset of being an aggressive investor into income-generating assets. The act of reinvesting the dividends, known as DRIP, can be fully automatic, and I would want to cover my fund price losses to keep the overall fund whole. I can sort of imagine myself with $300,000 in an IRA that is specific to this type of fund. I know that with a 35% dividend, like with YMAX, I could take out 28% of those dividends, or $84,000 a year, while reinvesting 7% back into the DRIP to offset the price drop of the fund. This would theoretically keep my portfolio going indefinitely while taking out a lot more than the traditional 4% that we all talk about in retirement. But since since this fund is so new, and big asterisks here, I don't know how well or poorly it would perform if the S&P 500 only had an 8% return in a given year, or even if it had a negative 20% return. This is merely one potential way that I could see people benefiting from YMAX. But for me personally, I am not an aggressive income investor, and I prefer to have the majority of my investments in growth stocks and funds. And if you'd like to see more on those topics, then I highly encourage that you check out one of these other videos. Thanks so much for watching, and now I can check that box for YieldMax.